I'm James Foster, Director of the Institute for International Economic Policy, or IIEP as we call it, at the George Washington University, and the moderator of today's discussion on the state of the economy in sub-Saharan Africa and its future prospects. Over the last several years, the GWREO Sub-Saharan Africa event has become a tradition in Foggy Bottom. I want to thank Andrew Kanyegiri of the IMF comms team for helping continue this tradition. I also would like to recognize the IAP team for organizing yet another interesting event in challenging times. Kyle Renner and Katya at the control booth with Jamie and Sarah on social media. Thank you. Today we have a terrific lineup of presenters from the IMF, including Andrew Tiffin and Sungmo Choi, both senior economists, and Preya Sharma, who is Special Assistant to the Director of the Africa Department. I'd like to extend a warm welcome to all of our presenters and to thank you for taking the 5-minute virtual walk from your headquarters to ours. Today's discussion will be starting off with Louise Fox, who is a non-resident scholar at Brookings and former chief economist of USAID, but most of us remember her from her time at the World Bank and her recent work on youth employment in sub-Saharan Africa, and also from teaching the occasional class at GW and later Berkeley. Next up is Stephen Smith, professor and chair of the GW Economics Department, former director of IAP and co-author of the best-selling text, Economic Development, with Michael Todaro, now in its 13th edition with Pearson. And finally, continuing IAP's tradition of collaborations with Citigroup on topics related to Africa, we have Esther Chibesa, who is head of Treasury and Trade Solutions for Sub-Saharan Africa, and Michael Mutiga, managing director and head of corporate finance for Sub-Saharan Africa, both of Citigroup. Welcome, and thank you all for providing your perspectives. For more information on our participants, please see the bios that are online or came with your invitation. Now, for those of you who've attended a previous IAP event, either in the Elliott School or online, you know you can expect a lively and informative conversation on such topics as US-China economic relations, urbanization and poverty, global economic governance, climate change, green finance, digital trade. In our webinar series, Facing Inequality, we have a multidisciplinary conversation in this most important of social and economic challenges. The fifth episode last week featured philosopher Christy Olson on measuring multidimensional inequality, while previous conversations have included political scientists, historians, sociologists, and economists presenting their perspectives. Videos from these and other events can be found on the IIP GW YouTube channel. Next week, political scientist Ben Braun of the Max Planck Institute will present Central Banking in the Age of Inequality, which considers the distributional implications of central bank policies. Also next week, we will host the US release of the 2020 Global Multidimensional Poverty Index, or MPI, featuring Sabina Alkire of Oxford, Pedro Conceição, director of the UNDP's Human Development Report Office, and yours truly. We hope to see you there. Before moving on to today's event, I'd like to invite my colleague Jennifer Cook to the virtual podium. Jennifer is the director of GW's Institute for African Studies in the Elliott School, which is co-sponsoring today's event. Jennifer?
Thank the panelists, thank our participants, and to say how grateful we are to be co-hosting this with IIEP, James, Kyle, and a team. The report that we're going to be discussing today, 3 very big topics relating to Africa: the impacts of COVID, climate change in Africa, digitization. We could have day-long conferences on each of those. And so I think bringing this kind of to the university setting where kind of students, faculty, researchers, and the broader policy community can be thinking through some of these big, big themes, I think just reading the reports opens up all kinds of new avenues for thinking, for research, for exploration, for our students and for the university community. So thank you very much for joining us on this. The report to the economic outlook is bleak. It's bleak reading, but within each of these, I think there are opportunities as well as the big challenges. Whether it's in economic growth, to my mind, the big challenge for Africa will be not simply building back and recovering, but how do you build back better? COVID has kind of the tide rolls back, revealing all the structural vulnerabilities of economies, including our own here in this country. How do you recover in a way that kind of builds back and addresses some of those vulnerabilities going forward? Climate change, it's been kind of sidelined by COVID at this point, but the big challenge that we all have to grapple with. But it does, in fact, and the report points out, open some opportunities in Africa in technologies, in manufacturing, perhaps, and so forth. Same with digitalization, as kind of can be something of a double-edged sword. On the whole, so I'm so looking forward to the presentations and hearing kind of the research behind them, but also pursuing some of these topics further down the line. So just again, thank you to James and his team, and thank you to the panelists and the participants today.
Well, and thank you, Jennifer. Now, the IMF's Regional Economic Outlook in 3 presentations. The first, entitled COVID-19, an Unprecedented Threat to Development, will be presented by Andrew Tiffin and discussed by Louise Fox. Andrew?
Okay. Thank you, James, and thank you to the IIP for giving us an opportunity to present here today. And thank you all for joining us for the presentation. So maybe before we start, perhaps some background on how the regional outlook process has changed this year. Usually we release 2 publications a year, one in April and one in October. Unsurprisingly, the April outlook was focused exclusively on the early stages of the pandemic and identified 4 key channels through which the crisis would likely impact the region. Slower global demand, lower prices for key exports, tighter global financial conditions, and the direct impact of local containment measures. But this is a fast-moving crisis, and rather than wait until October, last month we released an interim update. I won't rehash the key messages from the April publication, other than to note that the 4 concerns that we identified there remain as important as ever. For this presentation, I would like to focus on what we've learned over the past 3 months, both for the path of the pandemic in the region and for the policy options and responses of the authorities. So turning first to the pandemic. Most of you, I think, will be familiar with this chart, but for our purposes, a key thing to note is that the pandemic started a bit later in Africa. Moreover, even accounting for this late start, the incidence of new cases in Africa has been relatively modest compared to most other regions. But unlike many other countries, pandemic curves have not yet flattened for most African countries. Region-wide, we're still very much in the exponential phase. As of yesterday, we have now more than 600,000 cases in sub-Saharan Africa, and those are growing at a rate of about 3% per day, which represents a doubling every 3 weeks. And this rate of growth has remained remarkably steady for the past 2.5 months. So, in the face of the pandemic, our countries, like others, have implemented strict containment measures. And this chart tries to capture the impact of those measures on actual activity using Google mobility data. Many of you will have seen this data, but essentially it tries to keep track of how long you're in your place of work compared to the amount of time that you spent prior to the crisis in January. There's some variation across countries, but some key takeaways. By and large, our countries introduced containment measures towards the end of March and started easing them towards the end of April. Compared to other regions, countries in sub-Saharan Africa introduced the measures a bit earlier than in many other regions, and they also started easing restrictions a bit earlier than in many other regions. So if you look carefully, the impact of the measures in our region was slightly less than we've seen in other regions, particularly in Europe and Latin America. Now, this reflects not only the de jure stringency of the measures that we introduced, which are broadly in line with what we've seen elsewhere, but also the de facto ability of the authorities to enforce those measures and the actual ability of households to implement them while still maintaining any sort of semblance of a livelihood. So given that our countries are reopening their economies at a time when the pandemic is still on the upswing, one possible concern that we've seen in the literature is that early reopening may tend to undermine the objectives of having introduced the lockdown measures in the first place. So the question is this a concern for Africa? And from our point of view, the short answer is it's complicated and it's still a bit too early to tell. It is true that since the easing of measures in April, those countries that have eased have seen an acceleration in the pace of new cases. But it is also true that those countries that have eased also have a higher capacity for testing the population. So part of what we've seen is most likely a measurement issue. It's also true that those countries that eased first have eased their measures very cautiously, and they also tend to be countries with a greater health system capacity, so they have a greater capacity to deal with any unexpected developments. But to our mind, it's important not to be too complacent. Even for the best prepared countries, the sheer scale of this pandemic may still overwhelm local capacity. So a key message that we have in both April and our recent update is that ramping up health spending is more essential than ever for our countries. And also, there's still a very critical need for continued external support, both in terms of medical resources and expertise. So, turning to the authorities' economic response, monetary and financial policies have evolved pretty much in line with our expectations and advice from April. For those countries with policy space, they've cut policy rates relatively aggressively. Many have also injected significant amounts of liquidity into the banking system. In a few countries, authorities have allowed greater exchange rate flexibility to cushion terms of trade shocks, and a number of prudential authorities in the region have encouraged banks to work with their clients to restructure their debts, introduce debt payment holidays, and so on, to try and help them through this current period. On the fiscal side, as expected, a collapse in activity has resulted in a collapse in the tax base and a drop in revenues. In some countries, revenues have dropped by 20 to 40% within the space of a couple of months. For the year going forward, we now project that the region will lose about $70 billion in tax revenues. This is significant. It's almost about a quarter of what we had expected for the year. In addition to lower revenues, access to external funding has also tightened. As in other regions, the crisis prompted a sharp increase in borrowing costs and spreads. Now, it is true that over the past few months, those have come down, but they're still almost double what they were prior to the crisis. And they're still above the levels that we saw during the global financial crisis of 2008. There have also been significant capital outflows through the region. I think we saw almost 5 billion in outflows between February and May. We have seen some tentative signs last month that some inflows were returning, but it's still not sufficient to overcome what the outflows that we saw at the beginning of the crisis, and still none of our countries have yet gone back to the Eurobond market to issue. So, with a much tighter outlook on the funding side, many authorities are sharply constrained in their ability to mitigate the impact of the crisis and to support their economies. They are doing what they can, and the authorities have announced COVID-related fiscal packages averaging about 3% of GDP, which is insignificant. But as you can see from the chart on the right, that's a lot less than we're seeing elsewhere. It's almost half what we're seeing in other regions. Moreover, this effort to support this, to come up with a COVID-specific package is expected to come at the expense of other priorities, such as capital spending. So given the constraints that a lot of our countries face, we do expect a drop in expenditure going forward this year. But if we compare that to the $70 billion drop in revenues that we're anticipating, we still expect a significant increase in fiscal deficits and borrowing requirements going forward this year. I think the average is we're expecting is about 7.5% of GDP deficits this year, which is more than double what we saw in 2019. So what has the international community been doing to help? The immediate priority has been to try and provide countries with the added space they need to effectively tackle the crisis. On the part of the fund, we've modified the Catastrophe Containment and Relief Trust to provide immediate debt service relief for our poorest and most vulnerable members. We've also doubled access to our emergency lending facilities. So overall, with the emergency lending, it allows for a very rapid disbursement of funding without the same conditionality of our other facilities. And we have provided around $10 billion in additional support at very short notice to countries in the region. Also in April, the G20 announced the Debt Service Suspension Initiative, which allows the world's poorest countries, most of them in Africa, to suspend up to $14 billion in debt service payments between May and the end of the year. But we would stress that it's important not to be too self-congratulatory here. Despite our efforts, more international support is urgently required. Our estimates suggest that countries in Africa face additional funding needs of about $100 billion as a result of the COVID crisis, just in 2020. And so far, up to $40 billion of that still remains yet to be financed. So again, more help is needed. So in the context of these constraints, and in an effort to mitigate the economic and social impact of the crisis, a lot of our countries have been forced to do more with less and to husband what resources they have to try and make sure that the support that they're offering goes to those most in need. This is complicated by the fact that a lot of activity in our region is in the informal sector, where the workforce is not registered with the government and so doesn't fall within the safety net. So in response, a lot of countries in the region have used homegrown, often innovative approaches to try and expand the reach of their safety nets and try to make sure that resources go to areas that need them most. A lot of countries have leveraged the knowledge and expertise of local authorities in identifying households most in need. A lot of them have also tapped some non-traditional databases like voter rolls to try and broaden the scope of their social support. A number of countries have also introduced or reduced tariffs for key utilities such as water and electricity, and other countries have leveraged the opportunities in new technologies like mobile payments, which are cost-effective, very quick, and a very efficient way of getting money quickly to households that need it most. So despite these efforts, and trying to sum up, the outlook going forward is not encouraging. Since April, the outlook has deteriorated significantly. The regional economy is now projected to contract by 3.2% in 2020. It's double the contraction that we had anticipated just 3 months ago. And before the crisis, we had actually anticipated that the region would actually grow by 3.3%. We're now projecting that it will fall by 3.2%. We've revised projections down for the overwhelming majority of countries since April, with the largest revisions being for tourism-dependent countries like Comoros and Mauritius, where contractions are now sort of more than 10 to 15% anticipated for the year as a whole. For oil exporting countries, we've revised the outlook down by 2 percentage points. But for more diversified economies, such as Cote d'Ivoire, Rwanda, Uganda, they're faring relatively well. We've revised their growth down by about 1.5 percentage points, but they're still expected to remain positive overall. So looking forward, the longer term, a key message is that reaching the authorities' longer term development goals is now going to be a lot more difficult. Prior to the COVID crisis, we had estimated that Sustainable Development Goal spending needs would reach about $420 billion a year by 2030. Meeting that is now going to be much more difficult. Eliminating poverty by 2030, for example, is one of the goals. Has just been set back. The current COVID crisis is likely to cause the first increase in global poverty that we've seen since the Asian crisis of '98. And in sub-Saharan Africa, estimates suggest that over 26 million people are going to be pushed into extreme poverty in 2020 alone, solely as a result of this crisis. In addition, we would expect income inequality to increase as the lockdown measures have disproportionately affected certain sectors of the economy, particularly informal sector workers and small and medium-term enterprises that work in the services sector. So in terms of what's next, our key message is that the longer-term reform agenda is pretty much the same as it was prior to the crisis, but our countries now have significantly fewer resources to put that agenda into practice. And a key message is that the benefit of an extra dollar of assistance is now as high as it's ever been, not only in terms of helping our economies deal with the immediate impact of the pandemic, but also giving them the means with which to lift their economies out of the slump, and by giving them the resources and social support needed to restart the reform agenda that was needed to help them meet the Sustainable Development Goals. And with that, I'd like to thank you all for taking the time to listen. I would welcome your comments and questions. Thank you all.
Thank you so much, Andrew. Well, audience, now would be a good time to formulate questions, which can be submitted via the WebEx Q&A function. And I'll turn it over now to Louise Fox for the discussion. Louise.
Okay, thank you very much, James and Stephen and everybody at GW, Kyle and Katya, for asking me to comment today and for helping put this event together. It's just great. I think Andrew made an excellent presentation, shared a lot of really important stuff that we have to absorb. I'm making my comments on the short 10-page draft that was shared with me earlier. And I just want to start my comments by reminding that during the previous recession, that's the global financial crisis, Sub-Saharan Africa did much better than expected, especially if you take out South Africa compared to other developing countries. And so, you might have thought they would do better. But why did they do better in the past? Well, and this was a surprise, I have to say. In 2010, when we looked at these numbers, we were a bit surprised. And I would say our analysis suggests that, first of all, Sub-Saharan Africa in 2008-9 was somewhat insulated from the decline of rich countries, owing to a low share in global trade. Also, commodity prices were much higher. And I think importantly, the informal sector just chugged on and sustained some of these economies. And there was also low debt and fiscal space. And because of low debt and less integration into the global monetary system, they were less Sub-Saharan Africa, except for South Africa, were much less vulnerable to hot money outflows. So I would say on the next slide, the question is, what will happen this time? Will Sub-Saharan Africa do better than developing countries? And IMF says no, and I mostly agree. And what are my reasons? First of all, as has been mentioned, there's high debt, less fiscal space, and also high health costs, which didn't happen in 2008-9. And also really low commodity prices, which hurts the export earnings. And also the economic shutdown hit the informal sector very hard via the middle class, partly, and also partly the inability to just, for example, run markets. Informal sector, at least one half is retail sales. And, when you have a shutdown, it's hard to do retail sales. It's hard to get the stuff to sell, et cetera. So, but also what people forget is that one of the drivers for the informal sector is really the growing African middle class that buys from the informal sector. And so if they're suffering from job losses and income losses, that hits the informal sector. But I think a few other points that maybe weren't mentioned, but is important to consider, is this time there's no big Chinese stimulus, at least as far as we can tell. The IMF may have more information on that. But as far as we can tell, there's no big Chinese stimulus, which actually helped sustain export earnings for Africa previously. Informal cross-border trade shut down, and this had a big income effect during Ebola in West Africa, and I think that's part of your forecast of the income effect, especially on the bottom 50% for Africa. And then I think that governance weaknesses limit response effectiveness. And so that is, of course, a problem. And I think they matter a lot more than in 2008, 2010, 2009, 2010. So what about the future? Well, the IMF is quite bullish, and it's not clear. I would like to know something about their assumptions, especially about export demand, because that's quite important, really. Exports are, Sub-Saharan Africa has a very small share of world trade. I guess it's about 3%. But exports as a share of GDP average about 25% for Sub-Saharan Africa as a whole. And so a fall in demand for exports is a big issue. And I'd like to know what role that is playing in the IMF projections. The IMF text suggested that tourism would come back somehow. And I was a bit confused about how that might happen, especially who will pay for all the health measures needed to assure tourists that Africa will be safe. And I don't know how you're going to get people into planes at affordable prices to go to Africa, because Africa tourism is not mostly not sort of high end. business class tourists. It's mostly tourism packages packed into Ethiopian airline planes. Where will people eat? So I think I find the tourism to be a bit iffy at best. I'd like to see a discussion about whether ports will be affected by COVID-19, and that's both dry ports and ports on the coast, and whether that will slow down exports. Because ports on the coast. I mean, sailors are famous for being vectors for various diseases. So, and ports are always a problem. I just wondered some of this micro issue. The IMF suggested that Ethiopia will be positive this year, then it'll stall in 2021. What's going on? What are the assumptions there? So it would be nice to know who will see positive growth in 2021 and why, how. The IMF discussed a lot about the resource-rich countries and mineral prices. And that is an important element of who will see positive growth in 2021, but there are others as well. So I just listed out some of the known unknowns. I just want to say, first of all, I congratulate the IMF for actually doing projections in such an uncertain environment. So I really have to start there. It is tough. One is going to be proved wrong, one way or the other. Either you're too optimistic or too pessimistic. Sadly, studies have shown the World Bank and the IMF tend to be too optimistic. And I hope to God that you're not too optimistic this time. But we do have these known unknowns, especially about the world economy. And so the export demand, the tourism service demand, food prices, where are we expecting food prices? The good news for countries that import food is that overall agricultural prices are some of the lowest they've been in about 40 years or so. And also, but what about food exporters? And what about mineral prices? And what about debt restructuring? Honestly, debt restructuring could take 10 years. So we have this debt holiday, but if countries stop paying their debts, we know, we've seen this cycle before, and what the damage it wreaks on an economy when these global financial flows stop because of debt payment halting. So it would be nice to hear from the IMF a bit about what are their assumptions about debt restructuring. Of course, I mentioned the border impacts, the weather impacts. We had locusts this year. What's going to be next year? What did you build in? Did you build in a drought? You have to build in a drought every year somewhere in Africa, I think. And then finally, it would be interesting to have a discussion in Africa. What is the impact of women withdrawing from the labor force or working less because there's no childcare or school options? So obviously, we know that means households will earn less income, and I'd like to see some sensitivity analysis behind that. So overall, I congratulate the IMF for a thorough, for a great presentation and for really keeping us informed on the latest news. But I would suggest next time it would be great to have a sensitivity analysis. Thank you.
Great, Louise. Thank you so much. And I'm going to turn it back over to Andrew to respond to the questions, the many questions and comments you've given.
Thank you, Louise, for taking the time and for those interesting questions. Assumptions and our projections for 2021. I think one of the things I perhaps should have emphasized, and that we have emphasized in all our presentations, is the profound degree of uncertainty going forward. And all of the issues that you raise are entirely things that we also wrestle with are entirely correct. We do, our projections for 2021 do anticipate an improvement in the world economy, which will help our economies in the region. But again, that's something that is still extremely uncertain and something we can't take for granted. The recent news coming out is fairly mixed. Most recently, growth in China has surprised on the upside. The prospects for the US, on the other hand, are still somewhat uncertain, with a lot of financial market analysts weighing up the chances of a V-shaped recovery versus a W-shaped recovery. And again, so we have been relatively cautious in appearing too confident on what the next year will look like, and certainly any years beyond that. We take all these points, and again, these are all just senses of uncertainty. Maybe talking to tourism, I think the story there is perhaps mixed. The risks are all still there. We don't really know how the tourist sector will re-engage. It may probably depend differently from country to country. One of the things that surprised us as we looked into that is that compared to a lot of other regions, per tourist spending in Africa is actually relatively high. So we were surprised that, in contrast to our priors, that a lot of tourism in the region is actually relatively high end, and perhaps the scope for rebound there is greater than we might otherwise think. Again, I didn't have any specific comments on any of or the other details other than to sort of reinforce the fact that yes, our projections are still extremely uncertain at this stage. We haven't had the opportunity to do detailed sensitivity analysis. When we come out with our more regular update in October, I suspect that we may start to get into more details as to the impact of our various elements of uncertainty.